Good evening, everyone, or good morning, depending on the time zone you're in. Thanks again for listening in on series number 2 or topic number 2 in our series on the debt related opportunities. So, in this video, we'll talk about what constitutes a distressed asset. Number one. Number two, what are the causes of distress in commercial real estate? Spend a couple of minutes on that. And then number three, assessing distressed asset opportunities. What should we be looking for, and how do we know we're getting into good deals? And then lastly, the risks and rewards of distressed assets. So that being said, we'll get into the specifics here in a second. Before I go any further, if you're interested in deals like this and topics like this, just sign up for the investor education in the link below, and you'll also kind of see that up here on the investor, agilecapgroup.com/investor education. And appreciate the sign up so we can stay up to date as the new deals that we see as they come across our desks. So what constitutes a distressed asset? They are mainly financially troubled properties, often due to high vacancy rates, deferred maintenance, or unsustainable debt. And a lot of that really comes back to the previous owners who may not have underwritten the property well. You ultimately want to do these in good markets to where the rescue capital can take, so to speak, and do the job that it's supposed to do to be able to recover from the situation that the property may be in. A lot of these examples would include foreclosed properties, properties with unpaid taxes, and those that might be under receivership. So in the last video last week, we talked about loan to value ratio. And if it's an 85% loan to value ratio and you find that the occupancy drops, cap rates move in the wrong direction, all of a sudden the property's underwater, that would create a distressed opportunity. And so if you're able to come in and fix the occupancy and are confident in our ability to do so, or it's the asset management that's not being done, the assets not being managed properly, that can also be addressed quite easily with putting the right parties in place. So the markets need to be good. But at the same time, you've got to look at some of the mechanics to see, yes, the financial aspect can only recover, can provide so much input, but what also needs to be done from an operational perspective to drive the turnaround and get the asset where it needs to be. Causes of distress in commercial real estate. They can be economic cycles, and that's obvious. Unemployment rates, major employers move out, so you don't want to be in a single employer kind of a market. You want to be where there's diversity in the types of employers, in the industries. You want to be around hospitals, you want to be around car dealerships, you want to be around airports, you want to be around shipping, for example, or the energy industry. I mean, the list goes on, but you want to be in a diversified market to where you're able to access multiple different types of employers, different industries. And all of those things kind of hedge some of the downturns in certain industries and economic cycles. And then you also got to look at what are the policies? Are they in the right, are the policies in a direction where there is growth, job growth, wage growth, et cetera? And that's data that's easily accessible when you start the underwriting process on these types of situations. So poor management of the asset can lead to failure. And then obviously, like I mentioned, some of the areas around having the wrong kind of debt, a lot of times not having interest rate caps bought when the property is acquired can cause, in a rising interest rate environment, which is what we're seeing right now, that can absolutely create these types of opportunities. Bridge debt that might be at an expensive rate, and you find that the property can't sustain it, also creates an opportunity for acquisition and or rescue capital, so to speak. So a lot of this is really private equity in a way meets turnaround consulting. And that's the overall approach here. Number three, the assessing distressed assets and the opportunities therein. Obviously, there's got to be the due diligence and the underwriting. But the thing to look at is the physical asset. Is it in the right market? Is it in the right location, the right geography? And what is the physical condition? So there might be some deferred maintenance, but is that superficial, or are we talking about things like sewer lines need to be replaced? Because that can really break a deal. Some things are easily fixable. If you've got to paint the fences or you've got to paint some doors and put some screens up on windows or cover, the balconies, etc. Those things are relatively cosmetic and easily done. But if the deferred maintenance runs into things that are foundational or plumbing related, deep plumbing related, like sewer, as an example, you'll see, some of the due diligence includes scoping the sewer lines to make sure that, they are intact, because that can really run up quite a bill when you're looking at properties. And then obviously the financial condition, looking at things like occupancy, vacancy, how much of that is related to the market, and you can look at comps to get an idea for that, and how much of that is related to how the asset's being managed. I mean, a lot of this can be operational inefficiencies, not following up with tenants, not getting all of the paperwork right in the first place, and a little bit of, no better way to say it, but sloppiness in the process can lead to high vacancy rates. And those things are, good news is, they're relatively easily fixable. So superficial repairs, deferred maintenance, looking at things that are operational in nature that can easily be fixed. Also, a quick win. And then if the debt structure is upside down, rescue capital that bails out the asset and gets it on a proper track and a growth trajectory, if it's in the right market and the overall shell of the asset or the foundational aspects of the asset, the skeletal structure is sound, those can be some really good opportunities. So understanding that well can really drive some good opportunities as we're seeing the market turn here a little bit over the next 3 to 12 months. 3 to 6 to 12 months, we'll start seeing a lot of these opportunities, which is why I wanted to do this series. And then lastly, we've got things like debt restructuring, negotiating more favorable terms. A lot of times we can renegotiate with banks and lenders while infusing more capital and equity into a deal, and then clearly looking at the right local markets and then finding ways to be able to solve the operational aspects as well. The risks and rewards, the last topic, and this will lead into next week's video, is really about investing in distressed assets. It's a high return and highly leveraged. So if it's a $10 million asset that we were ultimately looking, the original buyer was projecting to sell, at a $14 million rate, at a $14 million sell price, and realize $4 million in equity, for example, on an initial equity investment that would drive significant improvement. If they're upside down, unable to sell, the value is stuck at 10. By infusing another $2 million, if we can get back to that $14 million projection, think about that. That's ultimately driving a highly leveraged opportunity where the $2 million can produce a return that's going to drive up to $4 million in value. So the bailout, if it's in the right market again, and the shell structure makes sense of the asset, it's foundationally sound, it's a highly leveraged opportunity. But again, the underwriting needs to be sharp. The mistakes that were made originally, buying bad debt, not assessing, the underwriting properly, not, evaluating the overall asset as it needed to be. I think the underwriting, as we've been talking about in previous videos on this channel, all are very much in focus here as well. Those foundations are very much, foundational aspects are very critical, obviously, in these types of assets. And then, so there's a high return, obviously, if the asset is underwritten properly and you're able to identify the opportunities. There can be some hidden costs, unexpected repairs. I mentioned sewer as an example, legal fees, restructuring that closely. There may be some debt repayment penalties. There may be some renegotiation fees. All of that needs to be looked at when you're in a turnaround kind of a situation, to be able to make sure that it is going to be economically viable. And then lastly, when you look at putting this together, the underwriting is one aspect on paper. That's kind of the engineering plans, if you will, financially looking at the asset, looking at it operationally. And then when you get into it, what are the changes that need to be made? The deferred maintenance, the operational aspect of it, how much capital is truly needed, how much reserve capital needs to be set aside to make sure that if there are some unforeseen delays in occupancy and vacancy continues to be a little lower than expected, can we address those things? So the shock testing, scenario testing that we do is even more critical in these types of scenarios. But the point is that there can be a significant reward on these rescue capital type of opportunities. And as we start seeing some of these types of opportunities coming on the market, and the bigger the asset, the more you can hedge it, because the chances of that being in the right market. Obviously, it needs its research, but on an 8-unit small multifamily, that's one thing that's got a different risk profile versus a 200-unit complex where you've got 93% occupancy in a 200-unit complex means one thing. 93% occupancy in an 8-unit complex is quite another. So looking at larger assets can obviously diversify risks, but you also got to make sure bigger deals, bigger underwriting requirements, bigger capital requirements, all of that's got to make proportionate sense in the type of asset you're looking at. Needless to say, it applies to both small and large, but you kind of need to look at both. So the punchline here is there is a lot of potential for some quick wins and some quick return and highly profitable returns on capital, but the underwriting needs to be done really well. And it needs to be structured in a way in which it all makes sense from an operational, financial, and market perspective, economic market perspective as well. Would love to hear your comments and feedback. A little bit of a longer video, 10 minutes. It's a complex topic with the 4 areas we covered. Look out for the next one where we talk about the rescue capital approaches and how we get into distressed assets. In the meanwhile, would love your comments and feedback and look forward to the next conversation and your feedback along the way. Thanks very much for watching.